Hi, I'm Peter Rose, founder of Longwood Currency Trading. I just made 1.5% on my money doing some day trading, and I thought I'd share that experience with you because it ties in with a previous video that I did as to whether you should trade once a day or multiple times a day. So I came out to kind of walk around and clear my head a little bit. I've been doing some research on a couple of topics. I'm working on a computer simulation program and mixing that in with my day trading. So I did my day trading earlier in the day. I spent a little bit longer at it than I normally would because I changed the process that I used for this particular session. In all my videos and discussion, I talk about developing your trading metrics based on an all-in, all-out type of trading basis. You go in with 1 lot, you come out with 3 lots. You go in with 5 lots, you come out with 5 lots. But once you get up in scale, in size, because I have a 6-figure account, you may not want to go in with a 10 or 12 or 15 lot position right at the start. You may not want to take that much risk. If your stop is 20 pips and you're trading a 10 lot position, you're $2,000, boom, gone, just like that. So you might be hesitant to want to do that. So that's where the building of a position and staging into a position comes, where you break a 10 lot into maybe open with a 5 and add a 3 and then march up from there. As a day trader, you're not trying to get 30 pips. You need to know that there's 30 pips of runway available to you so that you can go in a couple of times perhaps and do a couple of trades if you're successful at that. But you can't expect on a chart with a 5 period ATR, as I am on a major pair that I trade down on the 5-minute chart, 5 period ATR, 5 to 7, that you're going to not experience a retracement within a reasonable part of time before you get to 20 or 30 pips. You may get up 7 or 8 pips, and then you'll get a little stagger in the price, and you have to make a decision. Do I clear out now and take what I can get, which might be 3 to 5 pips on a 5 lot that you put in, and then wait, and then if it goes up a little further, you stage in your next thing and you go on from there, but you've lost the distance from the opening to, there's all that kind of stuff that you go through when you have a larger account that you're trading. Now, I've had some comments from, the reason I'm going carefully here is because we have this huge stump that I have to climb over. Getting some discussions through emails from folks that are saying, well, geez, what happens when you're trading, a mid 6-figure account and you really want to maximize the value there, but now you're getting me to let's say I'm trading 15 full lots or something, and 20 full lots. Last year I was trading positions 15 to 25 full lots. Took a bad hit at the end of the year, and so I'm back down to trading. Well, today I was trading a couple of 16 lot positions, but regardless of that, when you build a position or you stage into a position, you're changing the average position value and bringing it closer to the current price. And there's some mathematics that's involved in judging how much your initial entry lot size is, as opposed to the number of lots that you build the position with, your next staging point that you add lots to. What's the distance to that? How many lots do you put in? I've done computer simulation analysis on all that. I got all the math on that worked out. But the problem is that you are increasing the average position value, like I said. So that means instead of going all in, all out, I go all in with 5 lots. The price goes 10 pips. I see it weaken, boom, and I'm out at 10 pips, and I make $500 on the on that 10 pip trade with the five lots. Correspondingly, what do you do when you have 15 lots or 20 lots at stake? you may not want to risk that, as I said. What's the solution to that? Well, the solution is that when you get up to the point where you can trade a lot of lots, you figure out, well, what do I need to make on a daily basis to warrant the risk that I'm taking on entry? So if you're going to make $500 and you were trading 50 lots, that's not a real good return on the amount of the risk that you're taking, because at 50 lots you're trading at $500 a pip. The thing goes easily 2 pips against you and you're five large down, boom, gone. So, but in retrospect, if you could make $500 a day, that's 100 grand a year, right? So what's the solution to that? And I didn't mean, and I don't mean, to infer from my videos and the training and stuff, which I get into with someone I'm working with, that when you get up into those larger lot size positions, you have to utilize your metrics that you learned trading all in, all out, to trade in the same manner, except now, instead of looking for 10 pips, you're going to have to look for price to move 15 pips in your favor or 18 pips in your favor, because you're breaking that trade up into pieces. If you have high volatility situations, which there were today, then that becomes more plausible. The ATR on my, which is 14 period on a 5 minute, which is normally around 5 or 6 pips, probably today was around, 10 or 12 pips. It didn't go on that way for a long time, but it went on long enough for me to run swings during that period of being down $1,000, being up 1,500, being down 600, being up 800, you know, sloshing around all day because of that volatility, up and down and up and down and up and down. But I wasn't building the position and I wasn't staging. I have a large account, I have 6 figures, and so I can trade a large segment of that and make a good amount of money if I have to pull the plug early. So that's the key to the thing. If you're going to do all in, all out, you have to be able to say, if this thing short rings on me, what am I going to be able to make on a dollar basis? You forget about the percentage basis, the percentage win when you're scalping, because it doesn't matter. And your trading metrics, they go out the window because you don't have time to calculate any of that stuff or worry about any of that stuff. You either know how to trade or you don't know how to trade under the evergreen tree here. And so you identify a pip level multiplied by the number of lots that you're trading to say, gee, if I traded all day and all I was able to do was get that, would that give me, number one, enough dollar return for the day that I could be happy with that? Number two, would that ultimate dollar return translate into divided by the amount that you risk, not the money that's in your bank, but it's got to be done on a risk basis, would that equate to a respectable percentage? Even though you're taking that risk 2, 3, 4, 8 times, you're doing it on the same amount of money. And so it's the amount of money that you make divided by the risk that you take, not the risk that you take times the number of times that you took it, divided into the dollar amount that you won. That doesn't make any sense. Well, we don't do that in real estate unless you have large portfolios and stuff. You base it on each individual property. And so we do the same thing on a trade-by-trade basis. You base everything on that in that manner. And so when you are trading with a large amount of money, but you still don't want to risk the whole thing in doing that, but you still want to make, if you could make that every day, what's that going to come out to be? You know, if you could make $300 a day on average, that's $72,000 a year. And that's $300. So how hard is it to make $300? Well, if you're trading 3 full lots, it's 10 pips. So, you know, you have to balance all that with what your expectation is going to be of success. The problem with that is you're not going to make $300 just trading the 3 lots every day, because you're going to take losses for the day that could be $600, $700, $800, and you lost 4 or 5 times in a row. You could be $1,500, $2,000 down by churning through that trading process on that account. I'm in the sun. It's hot out. It's humid. But I did want to bring this up for a couple of the guys that are emailing me and wondering about, well, what happens if you do have a large account and then you want to move all in, all out on size? And the answer to that is you have to know how to trade. You have to know what you're doing. And so, you know, the other day I did that, experimented with that. I made $800 in, probably about 20 minutes. The day before that, I didn't follow my rules. I lost $2,600. And so the day after I made the 800, I made $1,500 back. And so it cost me 2 days of trading to make the $2,600 back. That's what you're going to run into when you start trading with size and you're going all in and coming all out. You have to be sure that you've built up a sufficient bank at the beginning of the counting period that you're in. If you use, say, a yearly basis and you've built up $6,000 or $8,000, $10,000 that you've won so far in the year, you're 3 months in or 4 months into your trading, and you lose $2,000 or $3,000, that's not a killer. It's only, you're taking, you know, maybe 20 or 30% off of the money that you've already made, but you're not digging into your starting bank balance that you had. So you're okay. Now for me, I try to keep track on things on a monthly basis because my win-to-loss ratio has changed from looking at a transactional value to that of a daily basis, because I'm trading such large numbers that looking at it on a transaction level doesn't really make any sense. Because some days I'll do one trade, and other days, well, like today, I did 15 or 20 trades. So the transactional basis of it really doesn't make any difference. It's the daily basis when you get out there. And so you have to start thinking, when you're trading large numbers, not the small numbers, when you're still trading, you know, 3 fulls or 4 fulls, you're still working on that transactional level. But when you get up to the higher levels, you do it on a daily basis. And so the fact that the other day I lost $2,600, that made my balls hurt. But I still said, you know, my wife went, "You did what?" I said, "That's okay, we'll make it back. We'll make it back." You know, she was out today, and I had to go down and get the dog. I had to pick her up and get the dog. So I go down to meet her to pick the dog up after she took the dog for a walk. And she said, "So how's the trading going?" I said, "Well, I'm down $1,700. She goes, "I didn't want to call you away from that." I said, "Well, you didn't call me away. That's just part of the game. I'll go back and I'll make that back." So I came back to the house, and in about an hour, I made $3,000. So I more than made up for that loss and ended up $1,500 to the good. But that's in, all out, multi-trade basis. Trading that large size account, sometimes I might break the trade into 2 hops or 3 hops, but those are very close together. They're not done the way you would learn how to stage. You know, when you're learning how to stage, your distances between stage values is much greater than you would ever suspect. But that's risk management. That's how you define risk management, and something that I'm very strong in working with folks on, because it's critical that you understand two things. Number one, how do I view risk management, and what are my metrics? Am I trading well based on the metrics that I'm doing, and not that so much the dollar amount, but the metrics? How are the metrics doing? And then you can get up and you can start using the compounding and building positions and staging and all the rest of the stuff. And when you get up into the larger account sizes where you can trade 10, 15, 20 lots at a time, then you start by staging and building, and then you get to the point where you've built up enough excess that you go back to, which is what I'm doing, to all in, all out, and just bang it away. Boom, 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 boom. But I know how to trade. And so I can switch between being a day trader. I can carry trade and hold the thing overnight. The other day I did a carry trade held overnight and made $500. While I woke up in the morning, the thing rung the cash register, and I was up $500. Well, I don't like to do that very much because I'm not in control when I'm sleeping. So I'm sitting at that terminal, and when I see that the volatility is greater than it would normally be, and that's of course a relative term based on the experience that you have in judging such things and your ability to interact with that volatility, that you'll go in, even trading a large account, you'll go into all in, all out, or you'll initiate the trade with what would be considered a large trade size. Like I was initiating trades with 8 lots and then adding to that as the position would go on. My risk obviously was 10 pips times $80 a pip, $800. So you got to be very careful that in your general trading you have a sufficient win to loss in order to reduce that. And then you can't wait 10 days to make the statistics come true for you. You've got to make the 10 trades that day, and 20 trades that day, or 30 trades that day, in order for your statistical trading statistics to come out such that you benefit from the aggregate of that. Look, if I make $6,000, if I make $1,000 6 times and I lose $1,000 4 times, I got a net of $2,000 over 10 days. That's 2 weeks. I make $1,000 a week. I'm making $50,000 a year. But what size bank am I trading with? Instead of making those 10 trades over the course of 2 weeks, why don't I make the 10 trades in a day? And then I make $6,000 that day, and I take off the $4,000 that I lost, and I make $2,000 for the day. Can you do that every day? I can tell you that you have to have a lot of experience in order not to be more fearful of the money that you're putting at risk than you have of a skill to make that money work for you and grow and make that money. And that when you do lose, you can't get all pissed off about it. You got to close the trade out, you got to look for the next entry, and you got to be able to hop right back in there. Or whether you go in at normal size, you go in and double it up. It's all based on what you think. I mean, I lost part of the $1,700 that I was behind today was because I was $600 or $700 underwater, and I closed that trade out. It jabbered around, and I thought, well, this has got to go here. That was the kiss of death, right? This has got to go here. And so I went back in, but I went back in a little heavier than I did on the first trade, and then I added to it 2 times, and those adds were very close together, and the son bitch turned around and went against me, and man, it was about $1,000, went really quick. I just shut it down. I think it was $1,250, and I just went, boom, close all. And then I go, Jesus, now I've got to make this back. I got to make $1,700 day loss. I got to make that back today. How am I going to do that? Well, I know what my win-to-loss ratio is. I know I can do that if I trade enough times. And that's what I did. I traded enough times, and I ended up today making $1,500. So there's about a $3,000 swing that day. If I wouldn't have been stupid and lost that $1,700, I could have been up I could have been up $3,000 for the day, maybe 4,000. So it's just really a process of understanding how to balance the assets that you have. It's like you're a general, and you're balancing your Marine forces with your Army and your Air Force, trying to get the best results possible from all of them. And so you have to do that with your trade. You've got your Army, which is your bank, and you've got strategies to trade, and you've got a battlefield that is going to dictate conditions to you that you're going to have to trade. Do I want to scalp today? Do I want to make 10 or 20 trades? Or, you know, maybe this is one of those things where you just load it up in the beginning. As price goes in your favor, you load again, and then you're done, and you let it go, and it goes 6 or 8 pips, and you make $700-800. You have to make those choices. There are decisions that we need to make as traders. And if you're not able to make those decisions like this 20 times a day, then you can't be a scalper. You can't do that short-term stuff. You could still go all in and come all out with a large account size, but you have to be willing to withstand the 10 or 20 pip stop that you're going to put on that initial entry. If you don't have good entry analysis, you're going to lose too much money, and it's going to freeze you up. So you have to be really careful of that. Anyway, I thought I'd just chat with you a little bit about that, because I had some comments in the emails about that topic as discussed in some of the more recent videos that I've done that have kind of got into that. So you might want to go back on the chart there and check out the titles of some of those videos and see if you can't pull some of those out and see the stuff that I've been talking about. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.